This is not really an exit for the venture capital firm. This is a pre-exit moment. Because the venture capital, when you go to the IPO, when you get
If you don't want to stand there and watch other people get rich, this is for you. Then you need to know about venture capital. Whether you want to seek investment, work in venture capital, or want to become a brilliant investor, stay tuned. This is for you, and it can really secure your future in the financial way. So today we're going to talk about 5 different exit strategies that you can use when exit a venture capital. It's going to be so excited, and this is for you that wants to know more about this and make money. Especially if you're a startup and you're bringing on venture capital money, it's really good knowledge for you. And also, we are powered by the LE Fitness today, which we are very happy about. Stay tuned. Let's go.
Let's go.
So let's start.
Top 5 exits that a VC firm will do, which means that the startup that a VC firm has invested in will do. And number 1 will be
the IPO.
The IPO. That is getting the shares noted at the public market, publicly traded. And that's huge, typically seen as the one exit that gives the best return of investment. And it's very fancy. It's really like you made it. It's really prestigious to get to ring that bell at Nasdaq New York or wherever.
So that's where the big money is.
Yeah. But of course, depending on what exchange you're going for, the qualifications will be higher or much, much lower. So not all IPOs are created equal. But that's the top exit, typically, that the VC firm wants to see your startup go through. They want it to happen. But also know, and this is really good for you to know, because few talk about this, this is not really an exit for the venture capital firm. This is a pre-exit moment. Because the venture capital, when you go to the IPO, when you get noted at the stock market, they're not selling their shares. They will be subject to a lock-in that can be 6 months, 12 months, or even 24. So this is a pre-exit happening. And then once the shares of the startup is traded at the stock market, then they can divest, as it's called, sell their shares.
Okay.
That's number 1.
Number 1. We're heading to number 2, which is the acquisitions M&A.
Yeah. So you heard about M&A, mergers and acquisitions. And the big part in that sentence will be the acquisition. That's when you get bought by another company, typically a strategic buyer, somebody who's in the same industry. Can also be a private equity firm or somebody else.
Okay.
But for instance, if you're a tech startup and Google comes knocking at your door and you sell to Google, then that was an acquisition. And that's also a really nice exit to have. It doesn't have to be, it can be a hardship exit, but typically it can be sweet.
That was number 2, the acquisition.
Yep.
And number 3 is secondary sale.
Secondary sale, that will mean that the VC firm only, if you have a startup and I'm the VC firm and I hold 25% in your startup, then you will not make a wholesale all the shares. Instead, the VC firm only sells its portion to somebody else. And that can be in a subsequent funding round when a new investor with new blood comes in, believing in the company, and they want a bigger stake, then I might be able to sell my portion, often at a discount, unfortunately. But if I don't really believe in the startup anymore, or I don't have the dry powder to continue to follow on investment, or for some other reason, perhaps I'm getting close to shutting my fund down, so I just want the liquidity, I might be willing to sell early because I don't really see the future, any potential for that great exit or return investment on my stake. It might be a down round also. So secondary sale where the VC sells their portion only.
Okay. That was number 3. The number 4, which is the MBA.
the management buyout.
Sounds cool.
Yeah, it is. It's really cool, and we're happy to have a separate episode. Let us know in the comments if you want us to dig down in how the MBO works, because it's super exciting. But to keep it short and simple, what you need to know, then it's the management, the current management of the startup says that, you know what, we'll buy you out. And the trouble with it is, of course, that the management then needs to find funding. So they're private persons running the company. They need to find other backers in order for this to go through. And this can often be the case if you see that the company is going okay. It has the revenue. It's perhaps making black figures even. But it's not that exit case that I, as the venture capital firm, was going for. So then this restructuring can happen. The MBO, the management buys out the current VC. So I get liquidity, I get to say thank you and bye. I have my cash back. I can send it back to my LPs, my investors. And then you have some other financing, some leverage finance typically. And continue on the journey.
That was number 4, the MBO. Number 5 then, it's the liquidation.
Liquidation or shutdown. It did not go as planned at all. No. So we're talking about bankruptcy. We're talking about an orderly shutdown. Sometimes perhaps you can sell off some IP or license something out, but in a shutdown, the venture capital firm will typically see no money at all.
Okay.
Because if there is any money left from selling the IP or something, there will typically be debt that needs to be paid, prioritized, anything from salary to bank loans that will go before us shareholders. So number 5, the exit, that is a shutdown or liquidity or just liquidating the company, bankruptcy.
It sounds like a worst case scenario.
So we went from
the best.
Number 1, IPO. Number 2, acquisition,
Yes.
part of an M&A deal. Number 3, we talk secondary sale, selling your portion to somebody else. Number 4, MBO, management buyout. And number 5 was the shutdown. There it is.
We don't want that to happen. We don't want that to happen.
No.
But now you know the top exit ways when you're exiting a VC.
And we have a sponsor.
We have a sponsor. It's the LE Fitness, which we are very happy to share. It's a gym chain.
Indeed. Very happy to be here. And key knowledge for your success, key?
Always keep educating yourself. And how do you do that? Yes, you're going to follow us, you're going to like, and you're going to subscribe and share our channel to your network. And comment.
If you want us to dig deep, you need more, you thought this was too high level, let us know. Drop a comment. We're there for you.
Yes. We'd like to hear from you. That was all for today. Now go rock on your venture capital.
Hej då!
Hej då!